As we track the live intraday movement of Datavault AI Inc., trading under the ticker symbol DVLT on the Nasdaq, the stock is currently sitting at $0.39, showing a minor upward tick of 0.46% during today's trading session on June 12, 2026. Looking at this sub-$1 valuation, it is easy to assume this is just another struggling microcap asset experiencing typical small-cap volatility. However, looking closely at the trading volume and order books across major retail channels like the Robinhood app and institutional venues reveals an intense tug-of-war that most retail players completely miss. While superficial screeners show a flat day, the real narrative lies in massive institutional short positioning colliding with aggressive retail accumulation on cheap fractional shares, a phenomenon frequently discussed across self-investing forums. This creates a highly volatile setup where the reported price numbers hide an impending structural break, proving that the surface data rarely tells the full story. The prevailing market consensus among casual observers using standard investing sites is that Datavault AI Inc. is simply trying to ride the coattails of larger tech names, positioning itself as a speculative bet on alternative data infrastructure. Investors see the recent name change from WISA Technologies as a corporate rebranding effort designed to capture retail attention alongside high-profile assets like Tesla stock or Nvidia stock. The common ground among participants is that the company is a high-risk microcap play with a long path to sustainable profit. But when you challenge that general belief with a deeper look, a far more complicated reality emerges. The business has shifted aggressively from consumer-focused wireless audio standards towards blockchain-based real-world asset tokenization and cyber-secure corporate data systems. This radical shift has completely decoupled the company from its historical fundamentals, creating a stark disconnect between what the broader market thinks it owns and what the company is actually building. Recent stock movement has been anything but quiet, characterized by massive daily swings that have left individual brokerage accounts highly exposed to sharp capital adjustments. Institutional activity indicates a significant amount of hedging, as short interest ratios have surged over the past few quarters following highly critical research notes from activist short sellers. These reports allege that the company relies heavily on promotional language rather than actual commercial traction. This triggered severe downward pressure, sending the asset towards its 52-week lows near $0.25 and prompting active investigations by multiple shareholder rights law firms regarding potential corporate governance issues. However, the trading volumes tell a story of defiance, as retail investors utilizing online investing tools have consistently bought dips, keeping liquidity exceptionally high for a company of this scale. This intense accumulation has turned the stock into a frequent favorite on the Robinhood trading platform and alternative online investment channels, where high-beta microcaps are constantly screened for sudden momentum reversals. Earnings reactions have further widened the gap between baseline expectations and realized financial health. The first quarter financial release for 2026 reported a wider-than-expected loss per share of -$0.09, missing consensus estimates by over 26%. This triggered immediate negative pressure in after-hours trading sessions, demonstrating how sensitive the equity is to pure operational metrics. The macroeconomic environment has not been helpful either, as high interest rates continue to punish pre-revenue and microcap companies by increasing the cost of capital and making speculative technology investments less attractive compared to stable yield assets. Sector momentum within the broader software and technology services space has favored massive megacap operators, leaving smaller companies to fight for remaining institutional allocations. Despite these headwinds, management has continuously issued announcements regarding large structured financing term sheets and tokenization mandates, attempting to balance dismal quarterly earnings with massive long-term promises. Understanding the internal mechanics of this equity requires looking at how modern retail participants interact with modern markets. Many young investors managing their individual brokerage allocations through platforms like SoFi Invest or utilizing investment help from automated services like Schwab Intelligent Portfolios are drawn to low-priced assets because they offer massive theoretical leverage. When a stock trades around 40 cents, a move of just a few dimes represents a double-digit return, a characteristic that standard blue-chip equities like Apple stock rarely provide on an average trading day. This reality drives intense speculative volume through mobile interfaces like the Robinhood app and alternative investing sites. Yet professionals managing diversified portfolios through institutional platforms like the Interactive Brokers platform look at this exact same data and see extreme structural risk. They focus on the high cash burn rate, potential share dilution from recent common stock offerings, and the operational friction of executing a massive business pivot, creating a fundamental divergence in market sentiment. To understand how Datavault AI Inc. arrived at this volatile intersection, we have to look back at its corporate lineage, which dates back to its incorporation in 2010. For over a decade, the business operated under names like Summit Semiconductor and WISA Technologies, focusing entirely on spatial audio wireless standards and high-definition sound transmission technology for home entertainment systems.
Its core business model relied on licensing patented acoustic technology to electronics manufacturers and selling wireless audio modules. While the technology received decent industry recognition, the consumer electronics market proved incredibly difficult to scale profitably, leading to years of consistent net losses and heavy reliance on debt and equity issuance to fund operations. Realizing the limitations of the wireless audio sector, the company executed a massive asset purchase at the end of 2024, acquiring cloud-based data management infrastructure, which culminated in the official name change to Datavault AI Inc. in early 2025. This older operational lineage is still present, as management recently discussed plans for a dividend spin-out of its acoustic sciences division into a separate public entity, an effort to cleanly separate its historical business from its new focus. Looking ahead, the future outlook for the company relies entirely on whether its new corporate focus can transition from press releases into verifiable top-line financial metrics. Several distinct catalysts could completely reshape the current valuation, starting with the execution of their reported global tokenization mandates across commodities like gold, copper, and geothermal energy. If these decentralized marketplaces see authentic commercial traction volume, the resulting revenue could quickly validate the current business model and force short sellers to cover their positions, sparking a rapid upward move. On the flip side, the risks are substantial. The ongoing legal investigations by shareholder rights firms could consolidate into formal class action lawsuits, draining corporate resources and damaging market credibility. Furthermore, if the company cannot secure sustainable non-dilutive financing, it may be forced to tap capital markets through additional equity offerings, diluting current shareholders and putting a hard ceiling on any near-term price appreciation. Comment below how many shares of Datavault AI Inc. you currently hold in your portfolio. Evaluating this asset requires balancing the aggressive optimism of retail momentum against the cold reality of traditional financial statements. For self-investing individuals using sophisticated trading suites like the Interactive Brokers platform or managing long-term retirement accounts through Fidelity Investments, the stock presents a classic high-stakes dilemma. The expectations surrounding the asset are filled with promises of decentralized data exchanges and multi-billion-dollar asset tokenization programs, while the reality is defined by significant quarterly losses, legal scrutiny, and an ongoing identity transition from a wireless audio manufacturer to a modern data enterprise. This massive gap between narrative and numbers ensures that the stock will remain a highly speculative battleground, where ultimate success depends entirely on executing operational milestones, rather than continuing a cycle of corporate restructuring and aggressive public relations. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.